Well, good afternoon, ladies and gentlemen. I hope you've enjoyed your lunch as much as I have. That was one of the finest pieces of steak I've had in a long time, and I've been enjoying this great view and having some good discussions around economics generally with Roy Robertson over here at Westpac. And also Russell Jones and I discovered that we actually went to school together some years ago, just some years ago. I've got the easy job. I'm going to be introducing you to Angela Onassis, who's the Client Solution Director at Randstad. She'll have a brief word. She's got some things to update you on, and then I'll introduce you to Paul Jenkins, who's a partner here at Ashurst. So, ladies and gentlemen, make Angela feel very welcome.
Good afternoon. It's a great pleasure to welcome you to the AB+F Randstad Leaders Lecture Series. My name is Angela Onassis and I'm the Director of Client Solutions at Randstad. Now, some of you may have heard this, but this is our part where we say we're the leading HR recruitment services organisation spanning over 40 countries and representing more than 90% of the global HR market. And this is probably the biggest stat that we're really proud of, and that we have over 520,000 people working for us every day with a mission of shaping the world of work. So we've been partnering with AB+F since 2010, and we're really proud of that association and the Leaders Series as well. So great opportunity to network. So today we'll be reflecting on, Phil, this is your bit, bank funding in the new environment and the provision of credit in Australia. So in spite of the stable environment, which is far more than Europe, Australian banks are still affected by the market's volatility and drying up of some credit markets. And at Randstad, we've really witnessed this, and we've really witnessed how organisations are trying to lift productivity or cut costs, and the banking environment is no exception. So some of what we've also witnessed is that some organisations are struggling to make headway in the face of increased regulation, and there's a few people that I've spoken to about that today, weak consumer demand and an increased Australian dollar. So, and also the continued global uncertainty. So tackling those challenges, well, I think this is an opportunity to really look at flexibility and strategic insights from business leaders. So in a few weeks' time, Randstad will be releasing for the first time in Australia the Randstad Work Pocket, and it's an HR employment guide. So designed to keep you up to date with labour market trends, HR issues and the development in employment legislation. So if you are interested, hop onto the website. It's www.randstad.com.au/work pocket. It's got that. So I'll be testing everyone a little bit later. And there's an order form there. So, or otherwise, good old-fashioned thing, just speak to someone, a Randstad representative, and we'll give you a copy as well. Cheers.
Thanks, Angela. I'm glad you enjoyed your steak, Andrew. I just wanted to now welcome Phil up here to talk to you this afternoon. The last 12 months have obviously been a very challenging time for bank CFOs, and I was thinking about what the issues are that are probably keeping bank CFOs awake at night. And the list that I had down were higher wholesale funding costs, low credit growth, subdued business lending, high market volatility, additional regulatory requirements and compliance costs, need for productivity gains and prudential changes. So they're the sort of things that I think Phil maybe is keeping Phil awake at night with some of the points that we'd like to hear about today. Our speaker today, though, Phil, has been extremely successful in his role at Westpac and was recently put forward as the CFO of the year by the AFR in terms of his Capital magazine. He's also been leading Westpac as CFO since 2005 and is now responsible for Westpac's finance, tax, treasury and investor relations function. So we welcome Phil to the stage today and look forward to hearing from you.
Well, thank you, Paul, and that might explain why I haven't been sleeping much in the last few years. Let me start by thanking you all for joining us this afternoon and listening to me. That's good, and I hopefully we'll put forward some things that you might find of interest. Thank you, AB+F, thank you, Randstad, and thank you, Ashurst, for hosting the lunch today. in thinking about what I was going to say, I guess I reflected on the fact that over the last couple of years there's been quite a lot of commentary that has been put forward in various forums talking about the funding pressures that banks are dealing with, the regulatory compliance burden that we have, and the way that we're changing the way we do business. And I think one of the challenges is that often those topics are actually presented in isolation. And I wanted to today to contribute to some of the discussion that's going on in the industry and to touch on what I think are three interrelated factors. The first is that the behaviours of our customers are changing. The second is that there are regulations that are prospective that are going to have quite material impacts on the way we do things. And bank risk appetites post the GFC environment have also changed. And I think all three elements of those factors come together, and they will change the way that banks' balance sheets emerge and the way that banks think about managing balance sheets, and they will also impact the way that the economic growth in the country emerges. So let me start by talking about customer preferences, and I think this slide probably tells more than anything I can say. This is the Westpac Melbourne Institute Consumer Sentiment Survey, and it picks up a lot of things, but one of the questions it specifically asks is, where would you put, where's the wisest place for savings? And back in March 2006, in those good old days, 28% of respondents said it was the safest place was to put it in bank deposits and cash, 11% said to pay down debt, and you can see the other categories there. Roll forward 6 years and 41% of respondents say deposits and cash and 23% say paying down debt. So in terms of our balance sheet, it's seriously reflecting the preferences of our customers to reduce the risk that they have by holding more of their savings in lower risk securities and to use surplus savings to pay down debt. And it's not just the consumer, because business customers similarly, excluding those who have been able to leverage themselves through the resources expansion that we've seen over the last few years, but outside of that group, business customers as well have said it's actually a good environment in which to reduce the amount of gearing that I've got, I'll pay down my debt, and where I've got surplus funds, I will also keep them in low risk deposits. And you can see that in the growth that we've had in business deposits. And when you put those two preferences together, you get a picture like this, which basically shows that if that's the line of 2007 and the commencement of the GFC, you can see how much deposits now have exceeded loans over that period. And in fact, if you look at since the end of 2007, deposits have grown 54% and loans have grown 19%. So that's a very material shift in what's happening in a bank's balance sheet. And as you can see, if you cast your mind back for another 15 odd years, for the most part of that period, the picture was quite different, with loans running quite a long way ahead of deposit growth. The second thing I wanted to touch on was the upcoming reform that the banks are going to be dealing with. And it's probably fair to say that the nature of that reform is so material that banks are already looking to pre-position themselves for that requirement and to be in a position where they can sustainably comply with those requirements when they come into force. And the two big, if you like, regulations that affect funding are the introduction of the liquidity coverage ratio in 2015 and the introduction of the net stable funding ratio requirement in 2018. And I think it's fair to say that with regard to the LCR, there's quite a lot of detail that we now know about it, and that is allowing us to prepare for it. Whereas I'd say with the NSFR, it's a 2018 introduction, and I think that there's a sense that there's quite a lot of calibration that still has to be done. And as a consequence, there's not as much focus around that. And I'm going to spend today just really focusing on the LCR. Now, the point of a liquidity coverage ratio is really to allow the regulator to feel that they have got sufficient time to deal with a crisis when it occurs at a bank. And the way that they've defined that is to say we want to be able to have 30 days in which we can come in and effectively ensure that the company either continues as a going concern or is managed in a way that minimises the impact on the system. So they basically say, look, we want to ensure that you as a bank are sustainable for 30 days of operation in a crisis. So the way that they define that is that they look at a bank's balance sheet and they assess the inflows and outflows that are likely to take place over that 30 days of crisis. And they say, as a bank, you need to be able to deal to that crisis yourself. So you need to be able to find forms of funding over that 30 days that meets the outflow that would take place in a crisis. And so very simplistically they say, show us how you've got committed funding that you can access, or you have liquid assets that you can sell down to create the funding that's going to be needed to meet the outflows that would take place during a crisis. And so what's been really important for us to get our head around is the rate of outflow that is going to be modelled by the regulator and that we need to be able to accommodate. And that's defined by APRA in a number of different ways, but one of the really important ways they define it is what's called the runoff factor. Now this is a pretty busy chart for a lunch, so I'll try to walk us through it. And we've tried to do quite a few things in this chart, and we're really proud of this chart because we haven't seen it anywhere else. So let me have a few minutes with it. So what we've started over here is we've defined the deposits that the way that APRA reports them or gets you to report them, and that you then see reported by brokers and the media over the course of every month. And they broadly say there are household deposits, there are deposits from non-financial corporates, and there are deposits that come in from financial corporations. And there's another set of certificates of deposit that are not on the chart, and that's another story altogether. So I have tried to not make this too complicated. So here we go. So we've got these three big buckets, and that's how they're reported today. But what APRA is saying, and quite rightly, is that within those big buckets there's quite different behaviour that you're likely to see as a consequence of the crisis. There are those deposits that are the most stable, and that's because they're either covered by an insurance or the government guarantee, and that means that they're less than $250,000, and because it's clear that the customer has a relationship with the bank. Those customers are least likely to take their money away holus bolus in the event of a crisis. And so the regulator says, on that basis, they're stable deposits, and the runoff factor that you should assume is 5%, which says that for all those deposits that are 30 days and under, you should assume that you're going to lose 5% of them. And if that's the case, then you need to hold liquid assets equivalent to that 5%. At the other end of the spectrum are financial corporations. And the argument there is that they're sophisticated entities, and they'll be quick to make sure that they don't get caught if there's a problem. And if that's the case, then you should assume you'd lose, for those deposits that have got 30 days and under to run, you should assume you're going to lose all of them. So if you have $100 of a 30-day deposit from a householder, you've got to hold $5 in liquid assets. But if you've got $100 of deposit from a financial institution with 30 days to run, you've got to hold the whole $100 in liquid assets. What we've tried to do, so you can see that there's various runoff factors for various levels of stickiness, if you like, that have been defined by the regulator. And we've tried to estimate today, based upon the average maturities that these various forms of customers have with us, what on average those runoff factors might look like. So for the household sector, which have got these three different components with three different runoff factors, we've estimated that between 7 and 12 cents of every deposit will need to be held, for every dollar of deposit will we need to held as a liquid asset. Whereas for corporations it's 25 to 35 cents, and for financial corporations it's 40 to 50 cents. So you can see emerging from this chart that different deposits clearly have different value for us as a source of funding. Those with the least amount of runoff are more valuable to us because more of those dollars that come in can be used by us to lend to our customers. Whereas those with the greatest level of runoff factor provide the least amount of opportunity for us to then on-lend them and make a margin. Now, just to kind of add to the complexity of this little exercise, the liquid assets that we hold come in two primary forms. Either purchased Tier 1 securities, government bonds and semi-government bonds, or access to a facility that the Reserve Bank will provide called the Committed Committed Liquidity Facility, the CLF. And the CLF is basically a way for the Reserve Bank to securitise and to repurchase securities that the bank has. And there's two main forms of that. If we bought a bank bond, that's eligible to go to the Reserve Bank to be converted into cash, or loans that we've already originated and securitised like mortgages are also eligible. And so the liquid assets we hold are really important in determining not only what's the cost of holding those liquid assets, but also just how much of it is actually going to absorb our own funding and how much of it we can actually use to lend, then securitise and then pledge to the Reserve Bank. So I think it's probably fair to say that there's still a lot of work that we're going to work through with regard to this situation. And we've got until 2015, so that's good. But there are some things that I think are pretty clear from this emerging picture. The first is that over time, you'd expect that deposit pricing is going to reflect the type of deposit, including the customer type. So the more that we're actually lending in these stable deposit forms, the more value they are to us, and therefore the more value we should be paying the customer. And similarly, the opposite for the least valuable types of deposit. The second thing is that longer term deposits are more valuable than short term deposits. If I have a term deposit for 6 months, I've got to use it for 5 before I have to hold a liquid asset against it. If I've only got it for 1 month, I'm already into holding liquid assets. So longer term deposits should be more valuable than shorter term deposits. And lastly, whatever is that cost of holding liquid assets will eventually be reflected in terms of what the deposit price is likely to be. So if that is the factors that drive deposit pricing, what do we expect to see as we head into 2015 and beyond is that we expect to see a lot less deposits being in that short-term 30-day bucket. And we expect to see banks saying, well, what else can I do to improve the quality of this and reduce my runoff? And you see up here, one of the things that's important is whether or not you've got a relationship with the customer. And the logic there is if you've got a relationship, the money is likely to be stickier. So there's an incentive now for both the bank and the customer to form a closer relationship which justifies holding less liquid assets. So I think we can say that at least we can say that those two things are most likely to happen as we look forward over the next few years. The last point I'll make on this whole exercise is I've talked about, well, these liquid assets can be held differently and they have some impact in terms of how much we can lend, because if I'm having to use the money I've raised to buy liquid assets, they're not available for me to lend to my customers. And so how that regime gets introduced and what form of liquid assets I'm allowed to hold is going to have an impact in terms of how much money I've got available to on-lend. For those of you who've been in banking for a while, or maybe even did your economics degree a little while ago, we used to have a regime where we had an LGS ratio and an SRD ratio. Banks had to hold certain portions of their assets in liquid government securities and a statutory reserve deposit. When those rules were changed and those regulations came off, we actually got a stimulus of credit in the system. And so I guess my concern at the moment, I think we have to work through, is as these new LCR ratios become more entrenched, do we end up having the opposite of that, which is a contractionary effect because of that? I'm sure that APRA and the RBA are onto it, but it's certainly an issue I think we need to be aware of. The third factor that I wanted to bring into today's discussion was a bank's risk appetite. And I think it won't surprise anybody in this room that, having watched Northern Rock fail and Dexia and Countrywide and Washington Mutual and others, that bank CFOs around the globe are worried about liquidity risk. And that's an issue that I think is probably in the background as opposed to the foreground, and I think it's worth bringing it a bit further forward. When thinking about liquidity risk, one of the things I think that is obvious that we're concerned about is our credit rating. What are the rating agencies saying about us? And the reason that that's important for Australian banks today is that our term borrowings come supported by those ratings, and our term wholesale borrowings amount to about $380 billion today. So if we lost the strength of our credit ratings, that volume of maturities would, I think, we would struggle to roll that whole volume over, and for sure the cost of rolling it over would be high. So we're definitely paying attention to what the rating agencies say and recognising their concerns around the resilience of our funding base. But it's not just the rating agencies. When we sit down and do our own scenario tests and think about what kind of risks that are we prepared to take to ensure that we still operate and that we are sustainable, we really do focus on those liquidity risks, and we think about them at least at Westpac, we think about them in two ways. We think about what's the risk that we're prepared to have for short-term wholesale, and there we're thinking about how do we ensure that we're able to operate for a year of really unsettled markets. And we worry about our long-term wholesale outstandings, and there we're worried about our refinancing risk. So we're worried about what's the amount of maturities we're prepared to have at any point in the future. So in 1 year's time, in 2 years' time, in 3 years' time, etc., how much maturities are we prepared to have? Because it's those maturities that are going to have to be refinanced at that point in time. And so we establish limits that constrain just how much exposure we can have to the wholesale markets, bearing in mind both those factors. I think that one of the things that has become incredibly acute in our minds is the fact that liquidity risk is not a linear type of equation. The risk doesn't just keep getting more and more and more. Confidence can be strong and then can evaporate very quickly. And so when setting those limits, we have to bear in mind that there is a point at which we would be feeling vulnerable to that sudden drop-off in confidence. Who knows why that might happen, but you have to bear that in mind when you're setting those kind of limit frameworks. And that has a pretty important factor for us as we think about how the balance sheet will emerge over time, because it says there is a point at which our appetite for wholesale runs out. And it doesn't really matter what happens to the price, we're not prepared to take on more risk. And that has as I said, has a fundamental effect, which I'll explain a little bit more in a minute, but it is really one of the features, I think, of this new environment that we're operating in that we need to bear in mind. So look, I think at the end of the day, what we've seen emerge is this very rapid increase in the funding cost of banks and a very rapid connected increase in the lending rate of banks when you compare it to the cash rate. And the logic behind that is how much deposits in particular have emerged as an incredibly valuable source of funding for banks. And banks in turn have been prepared to pay up for that value. Now, from time to time you read people who say, look, this is an irrational price war because it's a zero-sum game. If I win a deposit from you, then you want to win it back from me. The number of deposits doesn't increase a whole lot, but we can bid the price up without actually achieving anything. And I can sort of see that argument. But if you then go back and say, but wait a minute, deposits in absolute terms are more valuable today than other forms of funding, then you can start to see actually, whilst it might be somewhat circular, in terms of the relative value of deposits, they clearly are higher. And therefore, there is an absolute logic as to why we're paying more for them and why the overall funding cost of banking has gone up. Now, if that's the system that we're operating in going forward, I guess the next question that you now are seeing proposed in the media and elsewhere is, well, the system is not too bad off today because consumers want to invest in deposits where we started, and that's helping the banks change their funding mix, and that's all really good. But what happens when demand for credit comes back? What happens when householders start to get some more risk appetite and decide that actually I wouldn't mind using some of my deposits to buy equities? How does that then flow through, and what happens in the system in that circumstance? And so we've endeavoured to show that here with a circular flow of cash. We've used a very simplistic closed banking system, so money doesn't leave the system overseas or into the public purse. And used an example where a householder decides they're going to take $100 out of the bank deposit and buy an equity. And effectively what they do is they take the money out of the banking system, they use the $100, they buy it from the market. The market is effectively on the other side of this, let's say a fund manager. And the fund manager basically sells the share through to the householder. The fund manager's now got $100 and the fund manager puts that back into the banking system. So the banking system is still whole, it's got the $100, so that sounds pretty good. Why has anybody got a concern about that? And the answer is because that $100, which was sitting on the bank's balance sheet as a retail deposit, with the liquid assets that we have to hold against that, is now potentially on the bank's balance sheet as a wholesale deposit, with both a higher level of liquid asset requirement and a higher level of risk, because we're now starting to say, well, now that fits into my wholesale limit structure. So what would happen? Well, the first thing you'd expect to happen is that the rate of deposit that the banks were prepared to pay for the retail will be different from the rate that they'd be prepared to pay the wholesale. So they'll make some sort of price adjustment because they have to hold more liquid assets in the wholesale space, and they'll pass that cost on through the deposit back to the fund manager. So if that was all that took place and the price adjustment netted out, the bank says, I'm okay. But the bank also has to fund more of those liquid assets potentially. And that means they've got to go and find some more funding to be able to buy those liquid assets. If it's able to go back into the wholesale market and borrow a bit more from the wholesale market to buy the liquid assets and that all works out, no problems. But the question is, what happens in the scenario where the bank says, actually, I'm pretty close to my limit on wholesale. I don't really want to take another $100 of wholesale. I want to get $100 of retail to replace this householder that's taken their money away. In that case, the bank bids up deposits because it's trying to attract more retail deposits in, and probably then passes a bit of that on to lending, so the lending rates go up, and it tries to balance the system out that way. And if that is the case, then you'd see some more retail deposits in, you'd see a little less lending being done, and the system would solve in a different way than just everybody is happy because the loop keeps solving that way. Pre-GFC was not a problem. You just go and raise more wholesale, that didn't cost much, system solved. Post-GFC, in the world we're now talking about, there are different ways that this will solve. And it's likely to solve with changes in rates for deposits and lending, and changes in volumes for the deposits and lending as well. I thought I would go back to Economics 101 and try to show what this might look like using kind of some pretty basic economic diagrams. Thank goodness we've got some really good economists at Westpac, and so any errors are theirs, and anything that makes sense to you, I'm going to take credit for. So, and you thought, he's not really going to show an economics diagram, but yes, I am. So, it starts by saying, look, what happens when demand increases? So, you get this shift of the demand curve for credit. People want to borrow more money. So at the same interest rate, you want to borrow more money. So the demand curve shifts out from D1 to D2. Back in the pre-GFC days, that wasn't a problem because as the demand shifted up, so did supply respond to that. And you can see on that diagram that at the end of the day, you get this increase in credit supply, but you don't get much of a change in interest rates. And that was really what was happening really leading up to the 2007 period. We were able to raise a lot more money out of the wholesale markets at not much cost, and so you're able to meet the swings in demand that took place over that period by going into and out of the wholesale markets. And you didn't get the shifts in interest rates, which are particularly apparent today in the credit spreads, that we now get. In those good old days, that was how the system solved. The new regime has quite a different picture. Same increase in demand, but the supply curve that banks have is not able to be shifted out. And by the way, it's not a nice, neat curve that responds to each level of price with more volume. It's got some sort of kink, if you like, or a steepening of that curve. And the reason it's steepening is because we are running into that wholesale limit capacity. As we approach our risk tolerances, banks start to say, well, actually, I've got less money to lend, and I demand more and more rate return to take on that risk. And at a certain point, they say, actually, I'm up. I don't want to take on any more risk. Now, that's just part of the story, because clearly the provision of credit in Australia is more than just banks. And what we tried to do here was say, look, that's okay, that's the banking story, but there's another piece of supply that will get increasingly stimulated as interest rates move up or as returns get better. And that's often termed kind of either the shadow banking system or an alternative to the banking system. And that could be money that's coming in from corporate bond investors, could be money coming in from foreign banks, could be coming in from other non-bank securitisers or non-bank suppliers of credit. And clearly, as the returns go up, so that form of credit will be encouraged into the system. The issue here, though, I think, is that if you think about the speed at which that credit supply will turn up into the system, it's not as rapid and flexible to changes in demand as the banking system. So at the very minimum, that extra supply is going to be at a slower pace. The other key factor here, though, is that it's not equal for every form of credit demand or for every borrower. For a borrower who's got a household name, there's a lot of people that would be prepared to lend to them. Corporate bond investors will happily buy their corporate bonds, foreign banks will happily turn up. But what about Joe's fish shop? And lots of other SME customers and lots of other consumer customers. Those customers rely upon the banking system to do the credit evaluation of those customers. And so even though we will get alternative supplies of credit, it's not going to be necessarily available to some of the borrowers who would naturally be looking for access to additional credit. So I think we have to think through, yes, this is a good mechanism, it's going to help relieve some of the pressure that the banks are going to feel, but it's not going to be as fast and it's not going to be as universal. Now, if you put those things together, then I think it's reasonable to say that as demand increases, there is going to be some impact from rising rates from the banks. And so in some ways, the banking system is going to lean against an increase in the demand for credit. Now, I think in many cases, that's not going to necessarily be seen as a bad thing. It's going to be walking in lockstep with maybe what the Reserve Bank is looking to do in terms of taking some of the heat out of the credit demand. And so that kind of synchronisation won't be seen as a bad thing. I think the issue becomes what happens down the track if the opposite occurs. So roll forward a few years, let's say we've been operating in this system where credit growth has been higher and it's been happily being supplied by a combination of a more limited banking system and a bigger system provision from outside of the Australian banks. And then say, let's throw into that environment a global shock where credit demand drops and wholesale markets close up. And we've had real life experience, so we know what happens in that circumstance. One of the good things that happens is that deposit growth grows, which helps support the banking system. But one of the real challenges that takes place is that that shadow banking system, the non-banking system, retreats at an incredible pace. If we look back on what happened through the GFC, you get a pretty good idea of what that can look like. So in the space of 6 months, mortgage-backed securities dropped by 90 billion, and over a very similar time period, the exposure of major foreign banks to Australia dropped by 270 billion. So what we experienced back then was this massive inward shift of the supply curve. And we know that Australia was able to get through it because of the steps that the central bank took in terms of guaranteeing deposits and guaranteeing the bank's capacity to go into the wholesale markets globally. So let me kind of try to pull all these threads together and conclude what I think we do know and what I think we don't know. I think the first thing we know is that we are in this period of transition. And we will get to another equilibrium point where the banking system is funded in a more sustainable way, and that is on the horizon, but it's at least a number of years away. And that transition is going to be impacted by changing customer preferences, by the introduction of these new regulatory rules, and by the application of banks' credit appetite, particularly for liquidity risk. Some things we can say are likely to come from that. We are likely to have higher relative deposit rates, and they're going to stay for a good long period of time. We should expect that product innovation and rate differentials will actually change the quality mix of deposits for banks in a good way. And there's going to be an incentive for banks to deepen relationships with their customers. And I think we can see from this, at different stages of the economic cycle, banks are going to play a bigger and less role in terms of the provision of credit. Today, the Australian banks play an incredibly dominant role in the provision of credit. That's just because we're operating down here. As we move up through here, the provision of that credit from other sources will start to become a bigger portion of it, and so the banking concentration, if you like, will reduce. But there's still lots of other questions that I don't think we really have the answers to. We don't know how much customers will adjust to those pricing signals I talked about. And in particular, if you think about financial institutions, a lot of them have money sitting at call, in part because that's the way that their product set is set up. They might be trustees or nominee companies, or they might have accounts that they're managing for others where the monies need to be available. So they sit at call. So the question is how much of that is going to actually be impacted by the pricing change or by new products that emerge for those funds. And that's just one example of customers who would need to think through what they do with their customers as they start to respond to these changes in deposit rates. We need to work through and understand how much the introduction of these liquidity rules is going to impact our lending activity. The more that we have to hold liquid assets in forms that absorb our funding, the less we've got to lend. And we don't know how that is going to pan out. We don't know what this sort of combined supply curve is going to look like. And we put together the banking and the non-banking sector, what is that supply curve going to look like, and how quickly will interest rates respond to changes in credit demand. And we don't know how much supply from these non-banks is actually a really good, healthy thing for the system, and how much, or what tipping point it gets to where it becomes a vulnerability to the next downturn that makes our system less stable. So I think, in conclusion, it's clear that there's still a fair bit of thinking that needs to be done by regulators, by government policy, and by the industry. But I think we have to try to be consistent in what we're trying to solve for. And I think we are trying to solve for a safer banking system, but also a safer financial system, and a system that sustains economic growth. On that, thanks very much, and I'll hand back to Andrew.
Not so fast, Phil. Now's the time when the Q&A starts.
Oh, very good.
So this should be a little bit of fun. Maybe if we start with some of the broader picture issues before we get into some of the more specific issues. I've got a number of questions that you've raised in my mind around the possible retail corporate bond market, the implications here. But any broad questions to start with from the floor for Phil before we get into some of the more specific questions? Hand in the air. I'm happy to start. It's a bit like an auction, really, isn't it? Well, I will start then. Phil, it's inevitable that we're going to get some sort of banking inquiry. Tyler and I have been fortunate to have lunch with 3 of the 4 CEOs in the last few weeks of the major banks, and we've got Mike Smith next week, and every single one of them said, without exception, we're going to have a banking inquiry post-election. So my question to you is, if you had the chance to have influence and say, what would be some of the terms of reference that you might suggest would be helpful in a banking inquiry, given we're going to have one?
Yeah, well, I think I'd start by trying to change the title. So I'd want it to be a financial systems inquiry rather than a banking inquiry. And I'm heartened by the fact that I think the Shadow Treasurer, certainly, who's been promoting the concept of an inquiry for a while, has also called out that he thinks it would be inappropriate or incorrect to actually just have an inquiry around banking, particularly when you've got a superannuation system that's going to be larger than the banking system in a few years' time. So I think that would be the first thing, making sure that the scope encompassed the entire financial system. I think in all of these things, there's always trade-offs between the competitive environment and safety. And in some ways, the most safe system is just having one bank that's owned by the government. That doesn't feel very competitive, it doesn't feel very innovative, doesn't feel like it's going to give a good outcome to customers. But it might be really safe. The alternative is you have a system which I think the US represented pre the GFC, where you had thousands of banks, thousands of different types of financial institution, loads of forms of capital creation, and an incredibly unwieldy system when crisis hit.
That invited a lot of leverage.
Yeah. Well, because you couldn't really control it, you couldn't see it. It was so widely dispersed that what the health of the system was way beyond any kind of regulatory environment. They've got a regulatory environment that's got almost thousands of regulators, so that was never going to work very well. So I think we have to think about how you'd actually have a scope that says we're setting out to have a safer system, and at the same time we want to have a system that's competitive, that's innovative, that is open to entrance and that is open to competitive forces. And you have to think about both factors, I think.
And will support economic growth of the country in the region.
Yeah, well, I think, and because both of them will have their say at different stages of the economic cycle. You might actually have more growth when you've got a more dispersed financial system, but you're going to have less growth in a downturn when you have that kind of system. And that's the trade-off. And I think we should be trying to find an answer to it that says this gives us the best chance to have a sustainable economic growth picture.
Any questions on the floor before I go to my next question? Well, there's got to be something there from the floor.
Good on you, Michelle.
I'll be interested in your views on possible changes to the tax regime to encourage depositing savings.
Yeah. So I think one of the things that you regularly hear is that one of the solutions to this kind of situation is if we have a lot more corporate bonds. One, we have a deeper, more active, more involving corporate bond market, and that'll recirculate superannuation monies and other savings that are not in the banking system into those people who need credit. And to an extent, you'd say absolutely that makes sense, because there are forms of credit that would like to be deployed in Australia, but they don't want to lend them to banks, and we understand that. But for the point I made earlier, it doesn't suit all forms of borrower. There's by far and away the largest volume of borrowers in Australia are so broadly dispersed that the only system that's capable of assessing their credit is the banking system. We've got hundreds of credit officers who are doing that every day. If you're running a fixed income fund, you don't have hundreds of credit analysts working for you to decide whether or not you want to lend, 150,000 to Joe's Fish Shop. It's just not economical. So the economics of that says that that has to be done by the banking system, which brings you back to, well, if that is the case, how do I ensure that the banking system is getting its fair share of the savings of the country? And I think right now, that's a really good question to ask, because whilst we're getting strong deposit growth, the returns that our depositors are getting in a tax-affected way are less than they could get in other forms of investment which have got tax biases or tax preferences embedded in them. And so I think as part of this inquiry, I think it would be worthwhile looking at it and saying, and doing some proper analysis, because there are always trade-offs, but doing some analysis to say, are there things that I should be doing in terms of levelling the playing field that will lead to additional growth of deposits, which in turn will be available for borrowers who can't get their funding from any other system other than the banking system.
There is a point where, if we go back to the last slide, Phil, where that becomes...
Oh my God, I've broken it.
I'm sure it's there. One before that, sorry?
Good.
And one before that. I've got my slides mixed up at the moment. Keep going. That one. Where the corporate bond market comes in here, and the cost of running a corporate bond book within a bank financial institution becomes more expensive here under the new regulations. And the point that you've made, which I think is a very good one, is that there's only certain capabilities to run credit management within Australia. We've had a rundown in corporate management capabilities, credit management capabilities in this country since effectively asset consultants and fixed income managers got out of the active fixed income market. It's largely that money sent offshore if somebody wants to be an active fixed income manager. So we've really exacerbated a problem here in Australia and concentrated a problem here in Australia is we don't have effective credit management, with exception of within the banks where it is very good. Isn't that part of the problem? We are systemically not set up to have a corporate bond market because we haven't had active fixed income managers. They literally got out of that back in 2003. Is that not?
I think to their defence, the issue for them is as their pools of funds increase, how do they add value as a fixed income manager? And they need to have investments that are of a significant size, so enough of a size to actually change the return in the portfolio. And they're looking for elements of liquidity in that book as well. And when you put those two things together, the number of potential issuers in Australia is quite small.
There are only 60 or 70 rated corporates.
That's right. You get below the top 50 Australian corporates, and you're into credit positions that are actually quite complex
and
hard to see because they may not be listed companies.
And ABS 210 only exacerbates that problem, doesn't it?
Well, yeah, possibly. The reason I'm not sure as the ABS 210 piece is that this is really what we're talking about in terms of the deposit space. If you're talking about certificates of deposit and other forms of fixed interest investment, that's really outside of this whole exercise. That's another story again.
Yeah.
I'll come back another time.
Another time for that one. Okay. Any more questions from the floor down here?
Hi, Bernard Kellerman, editor of ABN. Here's a question you might find a bit easy to you mentioned very early on relationships are going to be really important in keeping depositors going, including the banks. The problem, as I see it, is that all the banks have trouble getting staff, training staff, teaching staff. That's put out to actually across that complexity. How are we seeing that going to be overcome? You don't see swarms of people coming into the banking industry.
Look, I think it's actually totally tied up with know your customer. Banks, for lots of reasons, need to know their customers better than maybe they did in the past. That could be for compliance, it could be to deal with anti-money laundering and all sorts of things. But there's also a positive incentive in knowing your customer. because the more that you know them and their needs and when they've got money and when they need to access that money, the more that you can actually respond to that. So I think that there's real value in the investment in that know your customer. Some of that is people investment, but some of that is actually better data management of what you're dealing with your customers on every single day. And I think as a banking system, what we will do today, we pay just as much for other banks pay just as much for a new deposit to them as they do to someone who's rolling over a deposit and has been doing that for the last 3 years. That only makes sense if you believe that the new depositor is going to stay with you for the next 3 years. If that new depositor is a really rate-sensitive person and is going to come to you only because of your price, and as soon as there's a better price is off to another one, that actually is not only is that not make a lot of sense from a banking relationship point of view, but these new rules are going to enshrine that it doesn't make sense to you from a funding point of view either, because your price-sensitive, non-relationship customer is going to have a much higher run-off factor. So it works down, is it over 250,000? And if it's no, great. Sorry, if it's under 250,000, great, it's stable. If it's not, so it's more, then is there an existing relationship, and is it kind of something that you can prove that it's not just at whim of the latest basis point? Okay, yes, that's a little less stable, but it's only 10%. But if it's no relationship, it's more than 250,000, it's price sensitive, 30% runoff factor. So for the same term deposit, you've got 6 times as many liquid assets that you're holding against it. So that kind of relationship incentive is quite material. So there'll be an incentive for banks to say, I need to know my customers better, I need to be able to deal with them in a way that attracts that relationship, pays them for the relationship, and the customer says, great, and because of that I want to stay with you longer as well.
In Europe they call that private banking, don't they? And there's a real emphasis to have a really premium relationship with your premium customer.
Yeah, and I think we do that in part today anyway. Everybody's got levels of private banking, personal banking, and we try to actually demonstrate that we know our customers better. All I'm saying is that there is a system that's going to come on that's going to make that really hardwired in terms of an incentive system. And it won't just be the really high-end private bankers, it'll be all the way through our customer base.
Which can't be a bad thing.
Which has got to be a good thing for a lot of people, I reckon.
Any more questions, Rocky?
Just in terms of relationships that we've been talking about, how do you tie that up with the fact that now customers can sort of push towards the internet banking as opposed to talking to a real person?
Yeah, well, I'd say that the internet banking shift is neutral. I'd say it's potentially in the benefit of the bank in terms of being able to process things in a cheaper way, and I'd say that there are a lot of customers that are saying, I want to be able to deal with my bank either in an online way or a mobile way. And you can see the take-up of mobile is probably one of the biggest shifts in banking that we've seen for a long time. And that doesn't reflect the banks, that's the way that consumers in lots of different forms of their life are saying, I love my mobile and I'm going to use it in lots of different ways. The challenge for us is then to say, well, if we are not communicating in a face-to-face way with our customers, how do we maintain that personal relationship? And I think you can see that there are lots of different ways that companies, banks included, are trying to do that. Both by using the data to say, I know you better, so I can actually promote things to you, I can send you messages that you'll find helpful. You don't have to come into the bank to get a question answered. You can do it when you feel like it on the train going home or wherever it might be. And I think it's also trying to show value add to the customer that represents the fact that you appreciate their business. So I'm not sure we've got all the answers for it, but I do think that there's no doubt that movement towards internet and mobile is taking place. There's no doubt we're going to have to respond to it. There's no doubt we're going to have to find ways to demonstrate relationships to find a sensible outcome for us and the customer. And we have to find that medium or that mechanism on that medium to do that.
If you don't ask the last question to Now all of a sudden the hands go up.
Firstly, thanks for the slides, Bill. They're very good. I'm very impressed with this one in front of me now. Probably a slightly different question. You talked about funding, but one of the things I get to hear a lot about is the concept of capital constraint. So particularly you've got a banking business, a wealth management business, and an insurance business. So I welcome perhaps a CFO perspective. How do you deal with capital constraint, and what are some of the thinking and perhaps some of the ways you're approaching that?
Well, I think capital management is a fantastic subject for another time, but we think of it in a number of different lenses. We think about capital as being something that represents the value that the shareholders have given us, and therefore return on capital is a really important metric that our shareholders expect to see. And so there is an advantage in not holding more capital than you need, because that helps you have a higher return on that capital. At the same time, banks all around the globe were found to not have enough capital through the GFC. And there's, in our mind, probably an even bigger advantage as being seen as strong and stable and here for the long haul. We're 194, 195 years old. We're not going to put at risk a franchise of that value by not being strong. And so that goes to how much capital we want to hold, as well as lots of other things. But being recognised as having strong capital is a really important priority for us. And then maybe a third lens is to say, I need to be generating enough capital to be able to pay a good dividend to my shareholders. You know, at Westpac we've almost got 50% of our shareholder base that's householders in Australia. Those shareholders are looking to hold us, not only because our price goes up, but because the dividend that we return to them is a really useful form of income for them. And so we want to be able to kind of get those balances right of returning the earnings we're generating in the form of dividends, but not at the expense of diminishment of our strength. When it comes to the how do we distribute capital across the company, we take into account the economic risk that each of those areas you mentioned, wealth, insurance, banking, etc., have, and we take into account the regulatory impulse that the regulator forces us to hold in terms of capital for various activities. Combination of that is the capital that we allocate to the businesses, and we expect them to optimise the return on that capital. And if we do a good job of that, then we're able to solve those other three things. I don't think we should take a question from Roy.
Tony Jones once had a comment on question. Just a sort of macro observation when you explained how the world's had a GFC, lots of bad things happen, and on the other side, households have become more cautious, non-mining companies become more cautious. Right now, miners are becoming more cautious. You explained how the banks have become more cautious, and over and above all that, you've got the regulators who think need new rules to make sure you become more cautious. So everything's so pro-cyclical and towards risk aversion. And I think that's one of the points we're making, that these new rules fitting the banks up with tougher liquidity rules at a time when everything's going that direction already.
I think that's one of the points, absolutely, Rory, that a lot of those things are pretty natural consequences of the environment we've been through. And so in some cases, the new regulatory rules are actually just reaffirming what we wanted to do ourselves in any case. But actually, as you introduce them, you have to make sure that you are doing things in a progressive way that doesn't cause some sort of further reaction of risk aversion, so even less growth than might take place. And more to the point, as you're introducing them on the banking system, you can't not look at the non-banking system, because, as I said, if in the next uptick lots of things take place in the non-banking sector, that's great, except what happens in the downturn? And so I think the regulators, and I think John Laker was absolutely onto this, are thinking, well, it's all well and good to have a safer banking system, but that's not the end game, because if we don't get a safer financial system at the same time, we haven't achieved anything.
Just a question on the retail bond market. There was a flurry of activity at the early part of the year, and we're seeing another one now. I'm curious, a lot of that money will presumably come out of the bank deposits, and if that market becomes more stable over time, how that sort of affects the top half of the slide up there. and whether retail deposits from ABIs will fall within that top half of the slide, because you mentioned certificates of deposit sort of fell
off the chart.
Off the chart.
Yeah. Well, I think if the funds are being raised by corporations, then they're going to need less lending from us. So it might be that we actually have a smaller balance sheet, which is both deposits are down and loans are down. Or it might be that they use the monies and they come back into our system, similar to the flow of funds I showed, which is rather than it being an institutional form of funding, it's a corporate form of funding. It comes into us, we have to hold a different level of deposits, and then the system goes on from there. So the money's going into the bond market, etc., not leaving the banking system, but they are emerging in different ways. And because they emerge in different ways, in our new world, they're going to have different impacts both in price and in terms of how much availability there is for funding.
Right, well, ladies and gentlemen, that concludes the Q&A for today. I'd like you to put your hands together for Phil Coffey. And the reason why Phil Coffey has picked up 2 CFO awards from Australian Banking and Finance magazines, he brings this sort of level discussion to the market. So congratulations, Phil. Great presentation, great topic, and I can tell you we're going to be writing about this for quite some time. Thank you. We've got one last more important job to do, and that is to draw, business card draw. The winner from Randstad have provided us with fantastic, I think it's a bottle of champagne, a very nice bottle of champagne. So I'm going to take this bowl of cards, I'm going to stir it around a little bit here, and I'm going to ask Russell Armstrong from Westpac to put his hand in. And Russell helped with can't be a red one. Can't be a red one. That one's not a red one. Russell, you want to read that out?
Here we go. Actually, I can't because I don't have glasses on.
I'll put my glasses on. And it's from Kingwood Mallison, and it's Brian Dunleavy. Brian, congratulations. Well done. Brian, we'll bring the campaign here. You're all the way down there in the back corner. I'd like to take this opportunity to once again thank our hosts for today, Ashurst. Paul Jenkins has been a banking partner for many, many years. I don't know how many because I haven't got it here in front of me, but I've known Paul and worked with Paul for many years in the guise of his work with the Australian Securitisation Forum and across the banking sector in general, and they do a fantastic job. Also, once again, Randstad for sponsoring this series. They are a great supporter of ours, and this Leaders Lecture Series has reached some great heights, today being one of them. But thank you all very much for coming along. We've got another Leaders Lecture Series coming up on the 27th of September with Andy Cornish. He's the CEO of IAG. And then we've also got next week, we've got the Breakfast with Economists. We have, I'm in Auckland on Monday, Melbourne is Tuesday, and then here in Sydney on Wednesday morning at 7:30 at the Ivy. And Bill Evans, the very colourful Bill Evans, will be sitting on that panel amongst others. So that should be a great discussion. Ladies and gentlemen, thank you very much. You have a great weekend, and we look forward to seeing you at the next one. Thank you.